Rebecca, great to have you here with us. Let's start with equities. What are you telling your clients to do amid all of this volatility and uncertainty?
Well, obviously we saw a little bit of a rebound Friday, but we expect, this is just a lot of stuff. We have so much data right now to take in. Obviously, it's earnings week. We have 53 companies of the actual S&P, reporting earnings this week. A lot of the Dow stocks reporting this week. So, it's just a time we're going to have to just wait and see. And overall, Nora, I expect, a correction, but I don't believe this is the beginning of it.
All right. So are you optimistic then going into this earnings season? Analysts are expecting about 19% rise in profits for the S&P 500 companies.
Yeah, I do. I think what's happening is a couple of things, especially tech stocks. I think that investors are saying, are earnings able to be repeated? Can we have this kind of year that we've had? An incredible year. I mean, look at Amazon, can we have this happen next year? And I think people are starting to say, gosh, this is going to be really hard to repeat next year. I also think that the rising interest rates, as we know, makes investors think that borrowing costs are going to be higher, profit margins are going to be squeezed. So we are looking at a lot of things happening, but combating that is a really strong, economic employment numbers, the lowest unemployment we've had since the 1969, the Vietnam War, really. So you've got that happening. So a lot of people are getting mixed signals, and obviously President Trump is upset with the Fed. And so we've got a lot of things happening. But I think, as far as the Federal Reserve policy goes, I expect for sure another rate increase in December. I think Chairman Powell made it very clear that unless we have a large substantial correction for an extended period of time, they would not reverse course. And I don't think that's what this is. And I don't think I think it'll bear out that it will come back.
Rebecca, to your point, do you think we're going to see a bit of a rotation into value shares, or is there still sustained growth that is possible for growth shares and in the tech names that you had mentioned?
Well, that is a good question. We never know who's going to be at the top of the chart every year, do we? But I do think that investors are starting to question whether or not this is the growth that we've seen this year, this explosive growth, can be sustained next year. And if it can't, there are people who are going to shift to value. Of course, the other thing is will they shift out of equities altogether? You're going to have a certain amount of people that have felt trapped in the equity market since we've had lower for longer, the lowest interest rates for the longest period of time. And now that we're starting to get some positive, decent, I'll call them decent, not great, but decent yields for the first time in 10 years on the 2-year, the first time in 7 years on the 10-year, you're going to have some investors that are going to move to bonds simply because they don't want to ride or take the risk. There's one thing that we're not talking about, Hope and Nora, and that is this is the longest bull market in the history of our country ever. So we are in uncharted territory, and there are some investors that are simply uncomfortable with that, even if the economic fundamentals still look really great.
That's right. And how do you get clients, maybe of yours, who might be uncomfortable, to understand that it'll be okay maybe if this does have to come to an end?
Yeah, I fully, to your point, Hope, I'm fully expecting a correction, and I don't believe this is it. I don't believe this is the start of it. But the truth is that with this long bull market, we've never had one this long. We are going to have some type of correction, whether it's the Fed deleveraging the balance sheet, the normalization of interest rate policy, some geopolitical threat, Chinese tariffs, how the G20 goes next month in Buenos Aires. There is going to be something that causes, a correction, and we need to be prepared for it, especially for clients that are at or near retirement, 10 years or from retirement, that can't afford to go through kind of a great recession type of correction. Those people need to definitely be planning around the coming correction.
Rebecca, for young investors who might not have ever seen a downturn like past generations, what advice do you have for them? Maybe people who are just starting out in investing.
Yeah, for the young investors, I don't worry about them so much because they can buy more, right? Like, that's an exciting time for a young investor. They have such a long trajectory, investment horizon. For them, it's like, it's the time to go into the candy shop and buy as much because it's not going to make you sick. For them, I'm excited for them. And I think that they should be excited because we can go back and show the 90s, the dot-com bubbles busting. We can show the Great Recession. We can show them examples of how this happens cyclically and we come back up. And so I'm not worried about the people that are in their 20s, 30s, maybe young 40s, late 40s. But once we're in our 50s and you want to retire early, or you want to retire and have freedom of a certain amount, then I start to worry about the correction for them. Because as we know, with the last correction, it took over 4.5 years for the market to really get back to exactly where it was before pre-correction, pre-Great Recession. So for the young people, I would tell them, ride the wave, enjoy it. That is the whole conventional advice I buy into, which is buy low, sell high. So you need to buy when it is low, and it will be low again, So they should be looking forward to it. For them, I'm excited.
Yeah, that's right. And they also often repeated advice is to get in the market early on. Long term is the best way to go. Rebecca, great to have you here with us. Rebecca Walser, president at Walser Wealth Management. Thanks again.
Thank you, ladies.